Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 13th of August. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about signs we need to look out for the potential bottoming of US equities. Now today, I want to start by looking at the epicenter of this latest sell-off, the Japan markets and the yen, and the broader implications on risky assets overall. Now, the Bank of Japan turning hawkish was the first trigger point, leading to forced short covering in the yen against the US dollar, as well as the liquidation of risky asset positions that the short yen was funding. This also hurt Japanese equities due to the correlation between yen weakness and equity market strength. Now, the bounce in both dollar yen and Japanese equities last week is not sufficient to sound the all clear. So what we saw earlier this month can be seen as a portfolio or VAR shock. And the first wave of a VAR shock involves forced liquidation of positions as increased cross-asset volatility and correlations push portfolio risk beyond established limits. But this forced risk reduction often involves selling what you can, as opposed to selling what you actually own. This may involve the use of hedges or proxy positions, which may reduce net exposure, but leaves gross exposure still elevated. So therefore, we may see a risk of another leg lower for risky assets, and therefore higher for volatility measures, as investors use the improvement in liquidity to reduce their gross portfolio risk. And this view is consistent with what our near-term technical model is showing, where we turn bearish equities for the first time in 2 years for the near term, a point that I talked about in the podcast yesterday. So all these leads to a very important risk consideration. So if volatility stays elevated and risky asset prices remain under downward pressure, that may well contribute to a steeper deceleration in economic momentum. So in layman's terms, this can be a case of volatility begets volatility, or the fears of economic growth deceleration crystallizing in a more actual economic deceleration. So this is what one must be on the watch out for. And it makes the upcoming US CPI figure to be released on Wednesday evening East Asian time a very delicate data release. So if we get a significantly lower than expected number, it may trigger growth concerns again and another round of de-risking. But on the other hand, if the inflation number were to be higher than expected, it may tie the hand of the Fed to ease significantly, which may lead to more confusion in the markets. So all this means that volatility is likely to stay in the very near term. But our view remains that investors should be using this volatility to scale into areas such as US growth stocks, because we do believe that we're dealing with a US soft landing scenario here. That's all for me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.